Welcome to Budget Barometer. As we count down to Union Budget 2017, every day on Budget Barometer, we measure the sentiment and assess the budget prospects for key sectors of the economy in association with BMR Associates. On the show today, Shefali Goradia, partner at BMR Associates, and our focus is on the financial services sector. Well, with India's push towards more digital, less cash, I think financial services as a whole, or certain segments of it, certainly find themselves interestingly poised, and it would be good to find out what the budget can deliver to push them on a higher growth path. Shefali Goradia, many thanks for your time here on NDTV. Let's get straight to it. And when I say that, I mean set the context. Financial services includes a fair bit, but ahead of the budget, how would you set the context?
Well, the government has already covered a lot of ground ahead of budget already. The concerns around the tax treaty availability for the international investors investing into India have already been addressed. India has already gone out and amended the treaty with Mauritius and Singapore and provided clarity in terms of what will be the eligibility criteria going forward. They've already got a transition plan for the next 2 years in terms of concessional tax rate, and for all the past investments, they've been provided for the grandfathering benefit. So I think that in itself is a lot of ground covered. It would bring a lot more stability and certainty on taxation of the foreign portfolio investors. What one still expects to see in the budget is some tweaking on the long-term gains. And, we've had a little bit of back and forth in this. We've seen some statements from the Prime Minister and then again contradicted by the Finance Minister that either the period of holding may change or the rate of tax may change. There seems to be an intent that the concessional rate provided for the long-term gains should be done away with or should be phased out and be brought at par with the short-term rate. This would cause some concern because that requires a lot of readjusting to the new instruments available in the market, and also in terms of the net returns that you would expect to see from these instruments. In terms of the foreign portfolio investors, the indirect transfer circular that was issued some time back, which caused the concern that there will be multiple level of taxation once when the funds divest from India, and then when that income is upstreamed to their investors, even the investors would be subject to tax. That already seems to be addressed partly by staying of that circular. Maybe one would expect to see that in the budget they would completely withdraw the circular and address all the concerns around the double taxation. Thirdly, I would say that some more of tweaks in the domestic fund manager regime. Okay. 2 years back, India did introduce the regime for India-based fund managers, which were advising the foreign funds, and whether that would create any tax risk for the foreign funds investing in India. They've given out a safe harbor for these India-based fund managers, but it is not robust enough. There are a lot of conditions attached, which makes it very difficult for anybody to practically make use of this safe harbor. So some more tweaks to make it more facilitative would be in order.
Okay, Shefali, I'm just going to park that to a side for a moment. And some of what I'm asking is already covered in your opening statements. But just from a policy perspective, what's the unfinished agenda for the government when it comes to financial services? Broad strokes.
Well, in terms of policies, of course, one has to still see action on some of the very key reports that we've seen in the past. So, for example, whether it is investing more capital into the public sector banks or acting on some of the recommendations of the committee that had given report on the alternative investments, where the funds from the pension funds as well as the insurance companies could be channelized into the AIFs. I think that would be something that would be called for. Also, in terms of the lower rate on the interest that has been provided, for which there is a sunset, which is going to be coming soon. also needs to be extended. There is a 5% concessional rate to channelize a lot more funding into the infrastructure sector, and the need continues to remain strong even today. So government stepping in to extend that concessional regime would again be something that we should look for.
I'm going to zero in on banks in particular. And again, I think this is a very interesting chapter that the traditional Indian banking system is going through. To your mind, what, statements and perhaps some action geared and focused towards the banking sector could this budget deliver?
So one thing that I can think of could be that, post demonetization, there is bound to be more of thrust to the banking sector in rural areas. And towards that, we might be seeing some more announcements, incentivizing banks to spread out in the rural areas. Secondly, also some concessions around service tax. While the government has announced exemption for certain limited transactions, for the digital transactions being routed through the banks, it is not entirely exempt. And there are some segments of that which is related to the interchange or the issuing bank that may still remain subject to service tax. So exempting all of that and extending this benefit to the entire ecosystem, which will then give a lot of boost to the digital transactions, should also be something that the government could focus on.
And I'm assuming that an element of it is also giving a boost to just secure, robust digital infrastructure as well, Shefali.
That's right. And, towards that, I think not just in terms of, facilitating, a smooth flow through reducing the taxes, but also allowing for the aggregation of data would also be something that we should look for, because that goes hand in hand with the entire move towards, digital transactions.
I was reading through the pre-conversation note that you had shared with us, and the Financial Data Management Center Bill 2016, it struck me as actually being an interesting, perhaps not attention-grabbing, but an important element. For the benefit of our viewers, can you just explain what that bill proposes and where we are on that bill?
Now, this is still pending with the government. The draft has been tabled. We haven't really seen much action after that, but it basically has a lot of provisions which allow the government to aggregate and analyze the data in a more comprehensive basis. So certainly once this bill is passed, we will see a lot more facilitation and sharing of the data within the government.
I want to turn my attention now towards the insurance sector and get your thoughts on A, what the budget can deliver, particularly B, from a parity perspective.
So one of the things that the insurance sector has been asking since long is there is a distinction in the benefits which are available to the life companies and to the general insurance companies. There is an exemption from MAT that they have been asking for, and also the ability to carry forward losses indefinitely. So these are the incentives that the insurance companies can expect from the government in the current budget.
Shefali, there's so much ground to cover today in our conversation, and some of it is very technical, which is why what I'm going to do is put keywords across to you, because if I try and thread this together, I might waste time. Masala bonds, they're in flavor. From the budget perspective, what are you hoping for?
So on masala bonds, I think there has been a lot of interest in the international market. These are the rupee-denominated bonds issued offshore. While there has been a press release from the government on the concessional tax rate, we haven't seen the amendment in the income tax law. And anything which is not sealed completely end-to-end, there remains that ambiguity and uncertainty. So one would hope that the government will clarify and bring this amendment in the law so that there is absolute certainty that it will be entitled to the concessional withholding tax of 5%. So the entire tax framework for the masala bonds as well as for the unsponsored ADRs and GDRs needs to be clarified through the amendment in the income tax law.
Offshore investment funds, what are they seeking?
The exemption for the portfolio investors, which currently exists only for the up to 5% investor in an offshore fund, that needs to be extended. And again, if you relate it back to the earlier discussion on the indirect transfers, in any ways, the investors were not meant to be taxed in the first place. If the fund is being subject to Indian tax, there is no merit in, again, taxing the investors. So this exemption needs to be widened at the least, if not completely, given as an assurance to the investors that they will not be paying tax if the fund itself has already been subject to tax.
Well, I'm weaving, crisscrossing, depending on how you feel. You're going to use one adjective over the other. But I'm moving a little bit towards the indirect tax bucket here. And again, there is the collateralized borrowing and lending operations market where some tweaking is required. What is that?
So there I would say that, already there are divergent views that are prevailing. I think the companies are taking position that this is not in the nature of service, it is in the nature of interest, should not be subject to service tax. But wherever there is some lack of clarity, there is bound to be litigation. And I think this is where the government could step in and try and solve all these pain points for the markets. They don't really need to do anything drastically. All they need to do is come out and clarify that these are either for the securitization transactions or for the CBOs, that these are in the nature of interest, and therefore there is no service element, which should not then lead to a service tax impact.
And a similar argument holds when it comes to applicability of service tax on entry-exit load charged by mutual funds, I understand.
That's correct, because again, these are the additional costs that are applied on the instrument. Again, there being no service element there is no merit in then applying service tax on it. But whatever is not clarified, automatically seems to get captured, either through some circulars or by practice on the ground within the service tax purview. So it would help to clarify these kind of transactions that are not subject to service tax.
Shefali Goradia, I'm going to leave it at that today. Many thanks for your insights, always detailed and yet comprehensive. Thanks for joining us today on Budget Barometer here on NDTV.
Thank you.
After the break, Abizer Diwanji, Partner and National Leader, Financial Services at EY. We extend the conversation on what Budget 2017 can and should deliver for the financial services sector after this quick break.